After a rough 2020, the first quarter of 2021 is expected to start off on a positive note for economic growth. Our current forecast for Q1 GDP growth is at 4.9% on an annualized basis, moving us closer to full GDP recovery, but still 1.4% below the previous peak in the fourth quarter of 2019. In today's episode, we'll go over what's driving this forecast and what we're looking out for on the horizon. Let's get into it. When you're doing an economic forecast, the most recent data can be just as important as your assumptions for the future. And looking at the current data that has come in for January, we seem to be seeing a tale of two economies, so to speak. On the one hand, retail sales surged 5.3% from December to January, one of the highest on record, and attributed primarily to the distribution of stimulus checks from the COVID relief legislation passed at the end of last December. We see this in the income statistics as well. Total personal income surged 10% from December to January, the highest since the 12.4% spike back in April 2020 when the first round of stimulus went out. All this happened while the labor market inched forward, with non-farm payrolls increasing just 0.03% from December to January. The same source for personal income statistics that I just referenced also showed that wages increased only 0.7%. So we have spending moving forward again at above average rates, but employment and wage growth coming in at rates far below historical averages.
While this papaya guy has been working on that GDP forecast, I've been working on something much better. I'm forecasting when these videos are going to get a lot better. After running all the numbers, it looks like when we hit 100 subscribers, things are really going to take off. And that's because I'm going to start finally taking over production so I can get out of this colorless box that I'm in all the time. So make sure to hit that thumbs up button and share this with everyone so we can get to 100 subscribers and start shaking things up a bit.
Looking ahead, we need to see job growth pick up so that wages can replace government stimulus as a source of income. The government has been fortunate that inflation is as low as it is right now, which is the only reason they're able to pursue a policy of currency creation to keep the economy moving forward through debt financing. If job growth does not pick up and get us back to where we were before the pandemic, then we're highly likely to see inflation increase if government stimulus continues at the pace of the last year. Basic economic theory tells us that if you greatly increase the supply of something, in this case the dollar, it goes down in value. Simply said, you can't just keep printing money without consequences at some point. If inflation remains low in February and March, we could very well be increasing our GDP forecast for the first quarter of 2021. With Congress on the cusp of passing another $1.9 trillion in stimulus, spending will greatly increase, resulting in higher GDP even on an inflation-adjusted basis. If you would like a PDF of our monthly forecast report, you can stop by our website at PapayaCast.com, where it is available for a free download. And while you're there, don't forget to sign up for a subscription, and we'll email you the PDF as soon as it's uploaded to our website each month. If you found this episode useful, please give it a thumbs up. And I hope you will consider subscribing to this channel so that we can continue to deliver you more valuable insights about the economy and how it will impact your life. If you didn't find it useful, go ahead and give it a thumbs down and let us know in the comment section below that forecasting is a fool's errand and that we probably get better predictions from getting a trained monkey to throw darts at economics graphs. Either way, I'll see you in the next video.